Good morning. These are the things that matter most for the U.S. pre-market. AI hardware demand is moving from chips into servers and PCs. Pershing Square is putting Netflix and large U.S. winners back on the positioning map. Airlines are testing how much consumers will still pay for premium travel, and oil plus yields remain the hidden cost channel behind the open. The central question for Wall Street is simple. Is this still a broad risk-on market, or is the tape starting to separate real cash flow proof from crowded stories? Start with Lenovo. MarketWatch reported that Lenovo profits soared past expectations on AI computers, servers, and services. That matters for U.S. investors because it is not only a China hardware headline. It tests the full AI chain that Wall Street keeps pricing: chips, servers, devices, cloud capacity, and enterprise budgets. The cleaner side is NVIDIA, AMD, and Supermicro if Lenovo confirms that AI demand is spreading beyond one narrow chip trade. Pressure sits with AI names that only have the label but cannot show orders, margins, or customer payback. For private investors, the useful filter is not whether AI is still exciting. It is whether AI spending is becoming revenue across the stack. Second, positioning is back in the story. MarketWatch reported that Bill Ackman is buying Netflix again after previously exiting the stake, and that Pershing Square also added 5 other stocks. The point is not to copy a fund manager. The point is that big investors are still looking for U.S. companies with durable cash flow, pricing power, and strategic scale. Potential beneficiaries are Netflix, Alphabet, Amazon, and other companies where market leadership is tied to cash generation rather than only a macro story. Pressure sits with crowded momentum names if the market starts asking who actually earns through a slower growth environment. The private investor takeaway is to watch whether leadership broadens into high-quality compounders or stays trapped in only the most crowded AI names. Third, the consumer margin signal is visible in airlines. MarketWatch reported that first class is getting cheaper if travelers give up some perks, as airlines create new tiers inside premium seats. That sounds like a travel story, but the market mechanism is pricing power. If companies need more versions of the same product to keep demand, then investors should ask where consumers are still strong and where margins are being protected by segmentation rather than volume. The cleaner side is airlines and travel companies that can segment demand without damaging brand value. Pressure sits with carriers and consumer-facing companies that need discounting to fill capacity. For private investors, the useful question is whether premium demand is resilient or whether companies are using smaller perks and more tiers to hide a softer consumer. Fourth, the underappreciated story is the cost channel behind almost every headline. Oil risk, freight costs, power prices, and treasury yields can all change the value of the same earnings beat. An AI server order is more valuable if power is available and yields stay calm. A consumer beat is more reliable if fuel and financing costs do not squeeze margins. The cleaner side is companies with balance sheet flexibility, pricing power, and direct exposure to infrastructure demand. Pressure sits with long-duration growth, high-debt companies, and margin-sensitive transport if costs rise at the same time as yields. The private investor filter is to connect the headline to the hidden input cost before treating it as bullish. Here is the stock-led watch list. In AI proof, watch NVIDIA, AMD, and Supermicro. In quality growth positioning, watch Netflix, Alphabet, and Amazon. In consumer pricing power, watch United Airlines, Delta, and American Airlines. In the cost channel, watch Exxon, Chevron, and the NASDAQ 100. Market bias, constructive, but proof-driven. The bullish version is that AI demand keeps moving into servers and devices, quality growth attracts real capital, consumer segmentation protects margins, and oil plus yields stay contained. The mistake to avoid is turning every strong headline into the same trade. Today's better filter is company group confirmation, AI revenue across the stack, fund manager positioning into cash flow leaders, airline pricing power, and whether the cost channel is quiet enough for risk appetite to hold. That is the U.S. pre-market brief for Thursday, August 13th. I will be back with the next brief before the next open. Research context only. This briefing is not investment advice, not a trading recommendation, and not personal financial guidance. No targets, stops, sizing, or portfolio instructions are provided.